Thank you so much for joining us today for one of our weekly webinars here. I'm Sam, and I'll be moderating this presentation for you. In just a second, we're going to be joined by Tyson Mayvar. Tyson is one of our senior financial advisors, and he is going to be talking to you about the complex decision on whether to take the lump sum or the annuity when you decide to retire from your company. After his presentation, he will also be answering a couple of the more popular questions we've received on the topic lately, so I invite you to stick around for those. If you find you have a question while he's speaking, please feel free to enter it in the Q&A box. It's completely anonymous. We try to answer as many questions as we can. Time permitted, of course. We do like to respect your time. What he does not get to, I will make sure another financial advisor gets to with you either over the phone or through email after the presentation has ended. You will also see some links in the chat. They will guide you to our retirement guide, as well as a link to book an appointment with either Tyson himself or one of our other financial advisors after the presentation. So please click on those links and take advantage of those. And I should just quickly remind you, we're not affiliated nor endorsed by any specific company. We are a completely independent group of financial advisors here. So please keep that in mind as you're listening along with Tyson today. And with all of that boring stuff out of the way now, let's get into the presentation with Tyson Mayvar.
Thank you, Sam.
Hey.
Thank you, folks, for attending our webinar series today. My name is Tyson Mayvar. I'm one of the retirement specialists here for the retirement group. Today, we're going to talk about one of the, I would say, hardest decisions for a lot of our clients to make when they leave their company, which is how to take their pension, whether as a lump sum or one of the various annuity options that their company offers. And every company has different pension options. Some of our clients don't even have a lump sum option on their pension. And it makes things more challenging when they do, because it's quite a difference between taking your pension as a lump sum versus a stream of payments for the rest of your life. So we're going to get into some of the merits of both options and what we see people enjoying in their retirement based on their circumstances, based on their family, their health, their risk tolerance, all these other variables that we want to get to know well before we make what is an irrevocable decision on how to take our pension benefit. So the common ones that we see, single life annuity, pretty much all pensions will have this. This is a payment option for the rest of your life and your life only. Once you pass away, the payments stop. But typically this is going to be the larger of all of the various annuity options. And you've got a joint and survivor, where typically it's just going to be one person, oftentimes a spouse, but doesn't always have to be, so that the pension is good for 2 lifetimes. We also, in some instances, will see different options, such as a leveling income, wherein you'll get less income until you qualify for Social Security. More income prior to Social Security and less income after you reach Social Security age. And then period certain is fairly common, wherein it's a lifetime annuity with some certain death benefits if you pass away early in retirement. But the 2 most common are the single life and the joint annuity. And then we also have the lump sum on some pension plans that can be great for some people and not so good for others. We'll talk about in what cases you might want to consider both. And then a look back period, where a lot of people don't realize how much of an impact interest rates have on lump sum and annuity payouts. We're going to talk about what look back periods are in reference to, and how to use those to make a good decision on which option to take, as well as the timing of your pension election. So single life annuity, more popular for single individuals, although just because you're married doesn't mean that you necessarily would want to take a joint annuity. We've had many married clients take the single life annuity just to get more income, and then potentially purchase a life insurance policy for their spouse with some of the money that was the difference between the single life and the joint annuity. We call that pension max. And maybe your spouse has benefits of his or her own, and we would want to be aware of that when we're making a decision. But this is going to be a popular option for somebody who maybe has a longer life expectancy than average here in the United States. Maybe you've got health, maybe there was people living a longer time frame historically in your family, or maybe your risk tolerance is much lower. Maybe you just can't stand fluctuations on your investments. And there's another reason that you may want to consider having a lifetime stream of payments. This is a very popular option for some of our clients And those are, I would say, two of the biggest reasons. Maybe you don't have beneficiaries that you care to leave money to, long life expectancy, or just disinterest in investing money. Now, typically, we'll still work with clients that take a single life annuity, or any annuity for that matter, and typically help them manage their 401k in retirement. And there's less decisions to make when you take the single life annuity, because you don't have to figure out how to invest that lump sum, which could be attractive to some, could be unattractive to others. But we do see this option taken by many of our clients for a variety of different reasons. Joint survivor annuity, typically it's because you have somebody, and it's not always a spouse, somebody that is dependent on you and your pension benefits, to where if you passed away, you would want to have still some income paid out to usually a spouse, but not always, could be a child. On some plans, only allow you to utilize this with a spouse. But it's going to be less money, of course, because the life expectancy of two people is always going to be longer than the life expectancy of one person. So you're going to take a discount, and there could be instances where that discount is worth taking. Oftentimes, there'll be several different sub options within this joint survivor, maybe 100%, 75%, 50%, or 25% joint annuity are very common, where basically you're choosing how much money you're giving up during your lifetime, you as the retiree, in order to give more income after your lifetime to your joint annuitant. And sometimes they'll even have a pop-up provision on these. So if you see that on your pension projection, usually it'll say with pop-up. What that means is that if your joint annuitant passes away first, you can actually recover some of that money that you gave up by taking the joint annuity compared to the single life annuity. It's not free, it's built into the calculation on the joint annuity, but that's what that pop-up means, is that there's going to be more income should your joint annuitant pass away first, because of course you'd be giving up benefits if there were not a pop-up provision in that specific situation. A lump sum, very popular. Really, I've been working for this company for close to 14 years now, and it's been very popular among our clients as long as I've worked with this company. It became very, very popular when interest rates went down, because on defined benefit pensions, in almost all cases, lower interest rates create higher lump sum payouts. And on the other side of that, when interest rates go up, lump sum payments go down, which has certainly happened in the last couple of years. The flip side of that is that when interest rates are higher, even though your lump sum might be lower, you can now produce a higher income stream with investments like bonds or fixed income investments in general. So while we still see a lot of people taking lump sums in this higher interest rate environment, you really want to be paying attention to interest rates on what they're doing to your lump sum payout, and then what alternatives do you have to invest that money into after you take that lump sum. Typically, people will roll that money over into a traditional IRA to continue to defer taxes on that money. Maybe they roll it over into their 401k. And so the options there are based on the tax benefits of both of those accounts, and both have different rules, as well as the investment options that you have in those types of accounts, 401ks and IRAs. And ultimately, how are you going to recreate your paycheck better in the lump sum than you would be able to in the annuity? Lump sum, typically, people that are concerned about inflation will lean more toward the lump sum because of the ability to hedge against inflation through your investments, whereas most corporate pensions, if you take the annuity, you don't get a cost of living adjustment. So inflation becomes a risk. The higher inflation goes, the more your purchasing power on your pension annuity is eroded over time. And especially if you live a long time, even though annuity can be good for somebody who lives a long life, because the company is on the hook to pay you that for the rest of your life, assuming they're still around for the rest of your life. If inflation is going to erode how much goods and services that pension is going to be able to buy you later in life, especially if inflation is very high. Now, a lot of people ask me, why, when interest rates go up, does my lump sum go down? And the best way that I can explain this is by likening it to a mortgage payment. If you were to go into a bank and you tell the lender your budget is $1,950 per month that you can put toward a home, put toward your mortgage. Well, if interest rates are at 4%, and it's a 30-year fixed, the bank might tell you that you can afford a home that is just over $408,000. Well, what if interest rates go down? It might be intuitive to think that your lump sum's going down, but in this case, like in a mortgage, if interest rates go down, if nothing has changed your budget, the amount of home you can afford actually goes up. Vice versa, if interest rates were to go up, and this is what happened to a lot of people in the last couple of years, kicking a lot of people out of the housing market, interest rates went up, and of course the amount of home people could afford went down, so a lot of people just couldn't even buy a home anymore. Same thing with the lump sum. It's an inverse relationship because of the time value of money. And another way to think of this is, what can I reinvest the proceeds of that lump sum into? And if interest rates are higher, you're going to be able to make more money on that lump sum. And as a result, the company does not have to give you as much money to create the same amount of income as you would be able to in that higher interest rate environment. Now, we also have something we track called a look back period, and every company observes this differently. What they'll do is they'll look back at the interest rates, and almost all companies are aligned in using the PPA rates, also known as the present value segment rates, which are actually 3 different interest rates used to calculate your lump sum. And they're based on corporate bond interest rates, short, intermediate, and long-term corporate bond interest rates. The IRS publishes these rates once per month, and they usually don't do it until about the 3rd week, sometimes even into the 4th week of the next month. So for example, if we are in September, we're not even going to know the August interest rates until sometime around the 20th through the 25th of September. Then we know the August interest rates. Then we also have to know, what's the look back period. Some companies will, like one company that we've done business with for a long time, AT&T, they'll use the November interest rates for the entire next year. So the interest rates that calculate lump sums are the same all year, and they only change them once per year. Another company I work with quite a bit is Chevron. They not only use the interest rates of 3 different months, the 3rd, 4th, and 5th month prior to the month that you're commencing your pension benefit. So also not is that necessarily tied to your retirement date. Many companies will allow you to defer the election of your pension. You can wait to take your pension in an effort to get a more favorable interest rate and more lump sum money, and something that we would certainly want to watch with you if you were a client of ours. And then all of those companies will not only use different months, but they will change them at a different frequency. So I was using the example of Chevron. Chevron changes their interest rates monthly. And so while if we were in September, they would be using not August or July, they'd be using June, May, and April. And then next month they would be using May, June, and July. So they'll just kick 1 month out and add 1 month, which means it's only going to be a very slight change for a company that does things like Chevron compared to a company that does things like AT&T. So it's very important to intimately understand how your company looks back at interest rates, which interest rates they use, and then some of the timing rules. And this is why we believe it's critical for your retirement advisor to have some clients from the company you're retiring from and have gone through this process so that they can help you to avoid mistakes and help you get as much money as you possibly can from your company, in this case, through your pension plan. I'll zoom in this slide just so we can see the most recently available rates go up through July of 2024. You can see there's 3 different rates here. The second segment rate carries by far the most weight in the calculation of your lump sum. For example, it's 3 times more relevant than the first segment rate because of the years that they're discounting back to a present value. So we focus most on the second segment rate, but the other 2 do have an impact. And you can actually see that interest rates have gone down the last 4 months in a row, at least as far as the second segment rate is concerned. They spiked a little bit in April. They're quite a bit higher than they were 2 years ago when interest rates really bottomed out during the pandemic. And now we're in an environment where, as a result of these higher interest rates, lump sum payouts are lower, but now things like money market accounts, CDs, bonds, they're all paying more interest, and we can produce a better return on our money if we have a typical retirement portfolio that's usually going to have some portion of money in stocks and some portion of money in fixed income investments or bonds. and then manage that to produce the income that our client is going to need throughout retirement, while also managing the risk of poor financial markets negatively impacting the sustainability of our client's retirement plan. Unfortunately, we found statistically 74% of Americans don't even have a written plan for their retirement. And we believe this is absolutely unacceptable, folks, because there's a variety of companies, including our own, that will do this for you on a complimentary basis for no other reason than just to get to know you and maybe increase the probability that you might choose them as your financial advisor when you retire. So take advantage of this. If you haven't done one with us, we're happy to do this for you. Usually takes about 10 minutes to gather the data we need to put it together, and usually about half an hour to an hour to review it with you in an in-person meeting or on a web meeting, explain to you everything that's going on, give you some pointers on things you might want to consider, whether it's how you're saving in your 401k, how you're invested in your 401k, which options could be more attractive to you on how to take your pension. We'll go into estate planning, some more advanced tax strategies like net unrealized appreciation, Roth conversions, and some other effective ways to get more bang for your buck in retirement. And this is all free. It's all complimentary. All we ask is that if you help us grow our business, if you found value in that exercise, by referring us to some of your coworkers. And then if you're interested in doing some business with us, we'll talk to you about the cost of our service and some of the other value propositions other than just managing investments. So we do have a little bit more time for questions. So Sam, I'm going to let you ask any questions, and we'll try to get to as many as we can on today's call.
Awesome. Thank you, Tyson. All right. First question. Can I take my lump sum now and invest in a tax advantaged vehicle like rollover IRA to avoid immediate tax consequences while still growing my savings? Long-winded question there.
Yeah, typically only if you're retired. So oftentimes you won't be able to do anything with your pension while you're still working until your retirement date. There's some exceptions to that on some cash balance plans over the years that companies have just wanted to get the liabilities off the books and let people roll those into a 401k or IRA, but it's very unlikely. But to answer your question, yes, you can roll over your pension lump sum into a traditional IRA. Very important. It's a traditional IRA to continue to defer taxes. You could move those funds to a Roth IRA, but then you're going to get taxed as ordinary income on the entire amount that you rolled over, which would typically throw you into a much higher tax bracket and rarely be advisable. There's some exceptions to that too. If you're a highly compensated employee, it's likely you'll have a portion of your pension plan that is non-qualified, and every company calls this something different. Sometimes they'll call it your supplemental pension, your non-qualified pension, your key employee makeup pension. If you're not sure if this is you, we're happy to walk through your pension projection with you and identify if a portion of that is going to be taxed as ordinary income upon your retirement. But that's going to be the case whether you take the lump sum or the annuity, just because of something called IRS 415 limits. But in most cases, you can roll over all or at least most of your pension to a qualified plan, continue deferring taxes until you actually withdraw the money from that qualified plan that the money was rolled into.
All righty, thank you. Second question. What happens to the lump sum or annuity if I pass away soon after retiring? In this instance, would one be a better choice over the other?
Yeah, it depends on which options for an annuity you have from your company.
Mm-hmm.
The lump sum, most people would lean toward because your beneficiaries will have full flexibility on what to do with that money, especially if, in this case, your life expectancy was short, right? In an annuity, there's always going to be a break-even point of essentially how long you have to live, given a certain assumed rate of return on your money, wherein you would be indifferent between the lump sum or the annuity. So let's just assume we identify, let's say we assume your rate of return is going to be 5% on average over time. And we find out that your break-even point is age 87. In other words, you had to live past 87 for the annuity to make more sense. Well, somebody who has a short life expectancy, the lump sum is always going to be better for the beneficiary because there was a lot more money. You didn't spend a whole lot of it, and it's going to pay you a whole lot more than the annuity would, given that short life expectancy. And the lump sum would certainly be better than the single life annuity because there's no death benefit on the single life annuity. Whereas the joint annuity, there's going to be at least some death benefit, or say, for instance, maybe it's a period certain annuity option. There's going to be some death benefit, but in a short life expectancy circumstance, the lump sum is almost always going to be better in this person's question. So there's also some beneficiary rules that you'd want to look into, I would say, on what happens if you pass away right before you retire and roll over your pension. And every company has different rules on that. Some of them will pay a lump sum death benefit equivalent to the joint survivor annuity. Some of them won't even have a lump sum death benefit. Know your options, and that also could play into when you decide to retire, because let's say you got sick right before you retired, and you might want to retire a little earlier so your beneficiaries have better options and could potentially get more money out of your pension benefit because of the timing of your retirement.
Right, that's definitely something that could take into consideration. Alrighty, Tyson, that was all we had time for today. We're out of time for this afternoon. I want to thank you, Tyson, for being here. Thank you, everyone, for joining us. Hopefully, you found some value. There is the link for that complimentary cash flow analysis. Please take advantage of that. Book an appointment, speak with Tyson directly, and get all of your questions answered. Thank you, Tyson. Thank you, everyone, for being here, and have a good afternoon.
Thanks, Sam. Thank you, folks.